Hello everyone, welcome back. In this lecture, we'll cover one of the limitations of accounting principles, which is accrual versus cash accounting. Financial analysts need to understand when the cash is received and when the transactions are made. Firms around the world either use accrual accounting or cash basis accounting. So, what is meant by accrual accounting and cash basis accounting? Let's look at the cash basis accounting first. For any business, cash is definitely important. Small businesses around the world, especially sole proprietor and partnership, normally use cash based accounting. It means the transactions will be recorded only when cash is received by the business. So, cash based accounting cannot be used if sales are made on credit, and we know that most large organizations deals with credit sales. So cash based accounting is not really applicable for large organizations or like corporations like Square Pharma, Bestingo Pharma, or some other big organizations around the world. Let's look at cash based accounting. What are the advantages and disadvantages of cash based accounting? First of all, with the cash basis accounting, it is really easy to track cash position of the business. So if a business uses cash basis accounting, it is much easier to identify the cash position of the business or liquidity of the business. Secondly, revenue is directly linked to cash if the business uses cash basis accounting. However, there are some disadvantages of cash basis accounting as well. Let's look at the disadvantages or limitations of cash basis accounting. First of all, if a business uses cash basis accounting, it will not link well to the business decision properly. Secondly, it is difficult to match the cash received from goods sold to the expenses incurred in making the goods. So if a business uses cash basis accounting, it is very difficult to match the cash received from the goods sold and the expenses incurred to make those goods. Now we'll look at accrual accounting. As firms grow into corporations, that means if a firm grows from sole proprietorship or partnership into corporation, the owners or shareholders often prefer accrual accounting. The reason behind is accrual accounting helps to track more accurately revenues and expenses. With accrual accounting, all transactions are recorded when they occur. That means even a transaction is made or even a sales is made on credit, it will be recorded as sales. Even there is no cash changes from hands to hand. So I have already said you that sales on credit are recorded immediately if business follows accrual accounting. Let's look at the advantages and disadvantages of accrual accounting. First of all, accrual accounting links to the business decision, or it helps financial analysts or managers to take business decision properly. Secondly, it matches cash received to expenses made. There are some disadvantages of accrual accounting as well. First of all, income statement may hide cash flows problem. If a business uses accrual accounting, it is not really easy to track cash flows which are generated from the business. So it might look that there are much revenue, there are great revenue and poor cash. If a business uses accrual accounting from its income statement, you might see that their profit is really high, but still their cash might be really poor. So, if a business uses accrual-based accounting, it requires monitoring cash flows separately. Now, there might be plenty of sales, but there might not be any cash for a business if a business uses accrual-based accounting. OneTel is one of the example which really suffered during 90s. The company grew very rapidly in the later half of the 1990s. It had more than 2 million customers and operation in 8 countries. In February 2001, OneTel revealed it lost 132 million over July to December 2000, and it was forecasted to run out of cash by April. OneTel collapsed in May 2001. The reason behind this was poor governance, poor financial reporting, and poor audit quality. Basically, OneTel is to use accrual-based accounting, and from its sales, it was not really easy to identify its cash. And what happened in May 2001, it collapsed because it didn't have much cash to run its operation. OneTel was really successful from the very beginning of its operation in attracting customers, boosting sales revenue, but its problem with that was with the operating cash flows. It didn't have any operating cash flows to run its business smoothly. OneTel had to pay employees and suppliers more rapidly, so that net operating cash flows was significantly negative. OneTel's operating cash flows to sales ratio was as low as 0.75, and due to these reasons, OneTel collapsed. So what we can learn from the operation or from the fall of OneTel: cash keeps us afloat. So if a business follows accrual-based accounting, we need to analyze the cash flows of the business properly, because from the income statement, you might see that the business has enough revenue, the business has enough profit in its income statement, but still the business might not have enough cash to run its operation. So if a business follows accrual-based accounting, we need to analyze its cash flows very carefully, because cash keeps us afloat. That's all about this lecture. In our next lecture, we'll cover the third limitations of accounting principles, which is profit versus wealth creation.